Putting stocks into categories is the first step in developing the story. At least you'll know what kind of story it's supposed to be. The category tells you what questions you should be asking about a company. You simply can't expect all stocks to behave the same. Basing a strategy on general maxims, like sell when you double your money or sell when the price falls 10%, is absolute folly. No formula will apply to all stocks. Different stocks behave differently, so they require different approaches, different expectations, and different kinds of stories. There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnarounds. At the end of this presentation, you'll have an opportunity to explore each category in more detail. In the meantime, remember, categories are guidelines. They are not hard rules. Some companies may not fit neatly into a category. Others may seem to be in 2 categories at once. Almost all companies change categories at some time throughout their lifetimes.
Look at Fannie Mae. From July through October 1990, the Standard & Poor's 500 fell 21%. Fannie Mae fell from about $42 a share to about $26, even though earnings were still increasing. This was a terrific time to buy Fannie Mae. The company was doing well, management was still great, the story was solid, and they had a very good business. But you got to buy the stock at a 38% discount. If you start by looking at the entire universe of stocks, more than 3,000 stocks on the New York Stock Exchange alone, and over 13,000 public companies in total, you'll blow a gasket. So I break stocks into categories, partly to make the job of researching more manageable.
Suppose you've made a 50% gain on 2 companies. One is a fast grower with a long way to go. The other is a big, lumbering, slow growth company that has already saturated 95% of its market, and that market itself is growing slowly. The 50% return is fantastic for the slow grower. The chances are it's time to sell it. The same 50% return could be just the tip of the iceberg for the fast grower. Fast growers, if successful, will always eventually slow their growth. They'll run out of places to go. Cyclicals experiencing long down cycles may become turnarounds. Once recovered, they probably will be cyclicals again. Use the categories as guides to help you build your story, but don't let them limit the questions you ask or the research you do. One thing we can say about companies in general: it's easier to go from $100 million in sales to $200 million in sales than it is to go from $10 billion in sales to $20 billion in sales. So smaller companies tend to have more upside potential than larger companies. But don't dismiss all big companies out of hand. Some big companies defy their size and find exciting new ways to grow their earnings. As well, good opportunities exist in companies that are cyclical, regardless of their size.
When most people think about investing in the stock market, they dream about investing in a fast grower, a company that is growing at over 25% a year. At 25% a year, a company's profits will double in 3. They quadruple in 6. They go up 8-fold in 9 years. That's how you get a huge stock in a decade. There's not a lot of these, but they're very powerful. And the best part is, you don't have to catch them just as they're taking off.
The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money.
What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. But you just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet and make sure the company can keep growing.
One way you can look at growth companies is think of baseball. A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They've got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores. And they had lots of malls to go to. Microsoft was a company you could have bought 3 years after it went public and made over 20 times your money. Sales and earnings were growing at several times the rate of the companies in the S&P 500 in an industry that was exploding by leaps and bounds. And it had a lot of potential both overseas and domestically. This was only the beginning of a 15 to 20 year growth cycle. You had plenty of time to get involved.